Well, hello, everyone. My name is Bob DiMeo. I am CEO of Fiducient Advisors. We are absolutely thrilled to have such an enormous turnout for today's program. Many clients and friends of the firm joining us, and Brad Long, myself, all of our colleagues, we're very pleased to have you on board. Frankly, I think it's our largest by a wide margin that we've ever had participate in our beginning of the year update, very timely update on economic and market. And we promise you'll walk away with some actionable ideas. In preparing for this, Brad and I asked ourselves a few questions, such as who is the audience and what do we want them to understand? Perhaps what do we ask that they think about, and what would we like them to be doing differently? And if you think about the audience, we've got all four segments of our clients represented on today's call. So you've got retirement plan sponsors, you've got endowment and foundation clients, many nonprofit organizations. We've got private clients and families, and then many of our financial institutions joining on today's call. And if we say, what we hope that folks understand, it's that, yes, absolutely, last year, 2022 was historically tough for the markets and beyond, but not unprecedented. And in terms of what to think about, that there are reasons to be optimistic. And then finally, what do we encourage folks to do different? And maybe this is at the risk of bearing the lead, but Brad Long is going to share some specifics regarding portfolio implications, asset classes we think investors should be increasing, decreasing, that sort of thing. So the format is, I'll shortly turn things over to Brad. He has some prepared remarks, but then we're welcoming questions along the way. And please just use the chat box and we'll get to that. We're going to do this all inside of 30 minutes. So we're excited to have you on board. Prior to turning things over to Brad, I'll really briefly touch on a firm update here. Many folks who attend this appreciate the annual update. And so in terms of clients served, I mentioned the four types of clients. And I will say here, it's really interesting. Almost every time we do this meeting, I talk about retirement plan sponsors, endowments, foundations, families, and financial institutions. Almost every year, someone says, and this is someone who might have been with us for 5, 10 years or more as a client, maybe a retirement plan sponsor, they'll reach out and say, you know, I thought, but I wasn't sure that you worked with nonprofits. I sit on this board. So anyway, we're grateful. I would say the majority of our business, new business, comes from referrals. So always good to remind folks about the four verticals that we work in. In addition, some of the milestones, over $230 billion in assets under advisement, growth in all four business lines. So with the markets the way they were, it wasn't our most robust year of growth, but pretty proud and praise our colleagues for the growth that we experienced across all four business lines. We also have a tremendous amount of intentionality around DE, I, and B, and we have a statement on that. We adopted the CFA DEI code last year formally. And if anybody would like to review our DEIB statement, happy to share that with you. And a lot of community involvement in 2022, and that's carrying right into the new year. In 2023, we've promoted a number of individuals, a number of new partners, number of new principals as well. We've invested a ton, not only in technology and hiring, but in training and mentoring and things of that nature. And then our annual investor conference, we're doing one big combined one in Boston in the fall, more to come there. And then I do want folks always to know that all 220 plus professionals at the firm, we are profoundly committed to helping clients prosper, knowing that means different things to different clients. Lastly, before we turn things over to Brad, I will simply touch on a couple of the additional metrics here. We grew headcount by over 11% last year. We added 13 new partners and principals. And then we look at a real positive in terms of clients, and then a real opportunity here. And the positive in terms of clients is the conviction and the confidence that they continue to show in us. We're working hard and partnering through these, let's say, challenging markets and environments. And then again, praise for our clients. We just view this as a great opportunity for growth. So with that, I'm looking forward to turning things over to Brad Long. Many of you know him. He creates a lot of our content. He appears on many of our videos and podcasts and such, but Brad is our Deputy Chief Investment Officer, and thrilled to have him walk through themes and then get to Q&A as we chug along. Brad?
Well, I guess good morning or good afternoon, everyone. As Bob mentioned, we have kind of 30 minutes front to stop here. we're going to spend, maybe half of our allotted remaining time, just walking through what we think is going to be most germane to you and your portfolio. But as we're going through it, think of questions. If we're not answering them, put them in the chat queue, because then we want to turn it over to you and answer anything that's on your mind and make sure we make this as helpful as possible as we think about 2023 and going forward. So for those of you that know us and know kind of our typical annual cadence, right, as we come through the year and we begin a new calendar year, we talk about the main things that are going to be driving markets in 2023 and beyond. It's not just bookended by December of 2023. And there are three principal things that we think are going to be very important to portfolios in 2023. And frankly, we'll talk a lot about, given these concepts, what are we doing in portfolios to take advantage of or potentially mitigate some of the risks underlying the key things we think are going to be driving markets. The first is this idea of persistent volatility. So don't take 2022 and just staple it on 2023 and think of volatility. We'll give you a little bit more context of how the kind of, call it, financial experiment we've been in over the last 15 or 16 years, really post GFC, with extraordinarily low interest rates, accommodative policies through quantitative easing and others. As we exit that financial experiment, we think we're going to revert back to more normal, I guess I'll use air quotes, normal economic environments. And that is going to create more volatility, but not in a nefarious way, just in a more typical way. And we'll talk about that and what that means to asset allocation. The second idea in 2023 that we think is going to be driving markets is moderating volatility. Hold on to the word moderating, right? We're not talking about extinguishing inflation or solving inflation. We're talking about moderating inflation. The good news for investors is we don't have to solve inflation in 2023. We just need a path towards resolution, and we think we're beginning, and we're on that path. The final point here is a bear market bottom. Those of you that know us, you're an investor with us, you've read our content, you've kind of consumed some of the things that we talk about and how we talk about asset allocation. We are not market timers. We're not saying, hey, it's January 12th and the markets are going to bottom, or March 15th or something like that. This last theme that we think is important in 2023, it's saying two primary things. One, we're closer to the end than we are to the beginning in this recent route of volatility, and we should be preparing for markets to move upwards. And that second concept of preparation, we don't have the benefit of precision. We can't say markets will bottom on March 7th or August 15th. We don't know that. But we'll use the power of preparation to build our portfolios in anticipation of that bottoming. And we'll talk about what that means to you and your asset allocation. So let's break into this idea of persistent volatility. And to really understand where we're coming from with this theme, we first have to take a step back and realize the environment that we've been in, the last, call it, post-global financial crisis. This environment has been the abnormal environment. So I've jokingly referred to 2022 as kind of the hangover year. It's the year in which we pull back the punch bowl, we've increased interest rates, the outstanding or long-standing material accommodations from monetary and fiscal policy, from low inflation, those have been really at the tail, they've been tailwinds for investors over the last 15 years. As we exit that, there's inferences from that. So let's try to normalize where we've been a little bit. So we look back to 1955 up to February 2006. Now, what's special about 2006? That's when Ben Bernanke became the chair of the Federal Reserve in 2006. And he's largely considered the father, or I guess maybe we'd say grandfather at this point, of quantitative easing and zero-bound interest rates. But let's go back over time, over history, and give context of where we've come from. So the average federal funds rate over that time period, 5.6%, well above where we are today. Average CPI, 4%. GDP, a little under 3.25, 3.23, and annualized return to the S&P 500 just under 11%. So let's call that normal or average or typical. Now we know the world doesn't exist in averages. In the 1970s, we had very high inflation and we had high interest rates. And there's context within this. But let's just use this as our North Star to contextualize where we've been over the last 15 years, 16 years. So let's go from February 2006 to March of 2022. Why March? That's when we started increasing interest rates just last year. Average Fed funds rate, 1.1%. And we know we've had a lot of periods of time in which that was effectively zero or 0 to 25 basis points. So very accommodative monetary policy. Average CPI, 2.2%. So well below long-term trend. Now that's an average. We know CPI is a lot higher today, and we'll get into the inferences of that in just a moment. GDP, well below that run rate, both sub 2%. Yet we've annualized a return on the S&P 500 of just under 15%, right? So extraordinary monetary policy, fiscal policies, low inflation had been a tailwind for markets. As we unwind that, and we've been in this odd period of kind of financial repression on the fixed income side, we do think that it's going to create a number of really important principles to asset allocation and how we drive and allocate portfolios. So if we look at just what has happened over the last year or so, one of the great charts that I think has come, in my mind at least, to embody this idea of unwinding this financial experiment is just negative yielding debt. Now, that's an odd concept to begin with, even if that wasn't a term we had heard a lot over the last couple of years. We had upwards of 18 trillion or more of negative yielding debt globally as of 2020. And you see this massive cascade in the unwind of negative yielding debt. That's kind of the picture of the loss of financial repression, if you will, or zero bound interest rates. But in this environment, there's also been a lot of other anomalies that have been created. So think of meme stocks, right? So stocks where their fundamentals might not necessarily dictate upward price movement, but their prices would have moved by hundreds or in some cases thousands of percent. Cryptocurrencies. Now, this isn't a damnation of all cryptocurrencies, but the notion of cryptocurrencies are independent of the market, they're on a public ledger, they're really not going to be related to stock or bond prices. I think the air has come out of that balloon pretty quickly in 2022. And a lot of these other concepts, like the idea of negative mortgages, just think about that. A bank is going to pay you, subsidize you, to lend money to you to go buy a financial asset. You don't have to take a big step back to look and say, that's a pretty odd environment. And there's a number of other examples that we can look at under the hood in this period of time. And so as we normalize back into this environment of where we think stocks will have higher volatility, bonds will have higher volatility, the correlation or cross allocation between those two will be more important. It tells us a lot about how we want to think about risk management, how we want to build humility in portfolios, and this theme of resiliency. If you've had an opportunity to read our 2023 paper, we talk a lot about building resiliency in portfolios. Lastly, I will leave this idea for investors that have been operating under probably a pretty simple playbook over the last 10 years. This idea of kind of buy the dip, the Fed will bail me out, or a Fed put. Growth is the only mantra towards success. Concentration, not diversification, is the key to success. So just own the S&P, not international. Or don't own the S&P, just own technology. Or don't just own technology, own the FANGs, Facebook, Apple, Amazon, Netflix, Google. The idea that very narrow success is the only path to success. Anyone that operates under that playbook of the last 10 years for the next 10 years, I think you might have the wrong playbook in your hand and you might be sorely disappointed with the outcomes going forward. So we need to think to the future, not necessarily rely just on the past. So that's this kind of first long-term theme of persistent volatility. The second is this idea around moderating inflation. Now, in 2022 is unquestionably the year of inflation, and by extension, the year of the Fed. And the Fed has had massive influence in the market and prices in 2022. Now, hopefully we had peak inflation in June, 9.1%. We've seen a moderating inflation. Actually, today we had CPI reported, kind of continuing December's data moving forward. But we have seen this kind of shift from supply side issues, right? In 2020, I can't find toilet paper, so I'll pay whatever I need to for it. In 2021, I can't find a car, so I'll pay whatever I need to. Those are supply side issues. 2022 is more demand side issues. I haven't taken a vacation in 2 years, so I'm going to pay a little bit more for that next flight. Those things are starting to moderate, and we can actually see it in the nearer term data. So this is November. We didn't have the benefit of using this morning's data in this presentation, but December data shows a very similar thing. November data, core CPI. So if we exclude things like energy and food, which are a little bit more volatile, it only rose month over month 0.2%. Now the bugaboo here in core CPI is a big part of that is actually shelter. And the way that CPI is calculated in shelter, it's kind of an odd thing. We've talked about this in a lot of our writings in the past. It's owner's equivalent rent. So not every American owns a home, so they have to figure out a way to not just home prices, but how much it costs to live somewhere. That's a pretty lagged variable. And so as home prices have been falling, as mortgage rates have been rising, actually CPI is showing shelter is increasing. So if we just hold shelter constant for the month of November as an example, and look at core CPI, that's ex food, ex energy, CPI actually fell 0.1% month over month, right? So we're moving in the right direction. Now, this doesn't mean that the curtain is going to drop on inflation in 2023. It's probably going to be a bumpy road towards 2% inflation, which the Fed would like to see. Investors, the key here is the path, right? We have a path towards moderation, and that allows the Fed to have a path towards moderating their hawkish stance, which allows us to build a market bottom and start to consolidate and then see rising prices from here. Which brings us to our final theme as we start to get into it. So the idea of a bear market bottom. And again, we're not market timers. We're not saying it's today or tomorrow or next month. Frankly, can there or will there be more volatility in 2023? Probably. It's likely. But nonetheless, without the power precision, we're going to use the power preparation. So why do we think 2023 on whole is a better year to be adding risk than it is to taking it away? Well, the typical pattern in which you see in pullbacks, there's kind of three things that occur. First, multiples fall. Second, if the Fed is an active participant, which Lord knows they were in 2022, they either pause or pivot. And then finals, kind of earnings. Earnings start to catch up, earnings fall, we build a better market bottom, and then we move up. Well, 2022 was undoubtedly the year of kind of multiple compression. So for those not familiar, if you just take the top price of the S&P 500, you can actually split it into two components. The earnings per share, so basically what businesses are creating in economic value, and the multiple that you'll pay for it. So you pay some times earnings per share. Now, the blue line here is earnings over 2023, and this closes as a Q3 because we don't have Q4 data. It's just coming out now. Let's call earnings flat as a whole for 2022. Now, as we close Q4, earnings are probably going to be down, but we won't speculate per se on that. Now, the dark blue line here is actually the price of the S&P. So even though earnings were flat, the price was down. The difference is multiple. People were less willing to pay for businesses, more for businesses. And so that multiples have retrenched and moved in a material way. So that's kind of that first phase of bear market bottoms. Next, we get the Fed, right? So the Fed is likely, on its way towards a terminal rate of say 5% or somewhere in that neighborhood. But we know the Fed will eventually stop raising. They're not going to raise to 15, they're not going to raise to 10. So we're closer to the end than we are to the beginning there. The final phase would be earnings. So let's unpack earnings a little bit because earnings are important to future success. So I mentioned this dark blue or this light blue line. It's basically flat for the year. Well, one of the reasons it's flat is earnings in the energy sector were a real boon this year, up almost 140%. So if we actually pull out earnings from the energy sector and look at the rest of the economy, you start to see this little dip here. Actually, earnings through the third quarter, ex energy, were down 5%. Okay, so what does that mean to me as an investor? Well, that means we're starting to see some of this knock-on effect of higher interest rates, higher wages. What does it mean to businesses? And we can start to consolidate. So if we use history as a guide, from peak to trough in earnings in previous pullbacks, earnings fall about 13%, call it low single digits, median. But it's not, there's a little bit more context in there. There's a little bit of is there a deep contractual, existential recession like the GFC, or is it more of a mild kind of economic pullback, a cyclical or classic kind of recession? And so if you actually break that out into its two components, earnings peak to trough in some of these more mild economic environments only fall about 3%, right? So based on where we are today, ex energy, we're kind of in that neighborhood. Whereas if we look at these GFC type events, earnings could have a lot further to fall. Now, if we have a bet, right, if there's something that we're saying is kind of embedded in our thought process, is that we're not entering an existential, deep, protracted recession in 2023, whether we enter one at all, right? We can talk a little bit about that in a bit. But if we do enter a recession, we think it's going to be far more mild. And so as we start to look at earnings bottoming, we're already 5% of the way there. If we get towards 7, 10, 13, right? Those are the numbers where we start to say, okay, markets are really starting to consolidate and it builds healthy footing. So with that in mind, we think we're far closer to kind of the end of this market route than we are to the beginning. And what does that mean? And how are we building into portfolios? Well, as I mentioned, persistent volatility, moderating inflation, and a bear market bottom. We're using the bear market bottom to prepare our portfolios for rising prices, but we're also doing so with humility and resiliency in portfolios because we know the future remains, as it always has, uncertain. And so how does that actually translate into our portfolios? Well, year over year, we're far more interested in owning high quality intermediate duration debt than we were last year. Yields are up materially, and we think with recharged yields, fixed income can actually play a great diversifier in portfolios, as opposed to the way it felt in 2022, which is like, it almost felt like an equity surrogate. We're funding that position mostly through what's called dynamic bonds, which is kind of more flexible, shorter term bonds. On the municipal side, for taxable investors, similar principles apply. The municipal market, far more interesting today, far higher yields. As we look across equity markets, now, equity markets, again, I mentioned the narrowness of success over the last many years has been the S&P, in particular large cap, in particular kind of technology or a narrow band. We're moving against that, see great opportunity in small caps here in the United States. One, the idea of small caps tend to rebound far more vigorously from bear market bottoms than large caps do, and so that's part of our preparation. International here, we entered the year overweight. Frankly, that was a good position for us in 2022. We remain there today, but we're not adding to that position just based on humility and some of the geopolitical risks that exist outside the United States. But don't take the double dashes as we don't like international. Frankly, we do, and that's a position that we remain in portfolios today. So kind of key takeaways, fixed income is far more interesting to us with a 200% increase in yields year over year. As we look at small caps, there's a valuation catalyst. They're very inexpensive and positioning kind of for that bear market bottom. And then that overweight to non-US. As the dollar potentially weakens here, as we saw in the fourth quarter, as the valuations start to really play out over the years to come, we think non-US positions can add materially to portfolios over time. So Bob, I know we had a lot of questions coming in, so why don't I pause there and see kind of what questions we have thus far.
Yeah, that's great, Brett. Thanks for that concise and I think insightful summary there. So I'll start with one question. There are a number in the chat, so we'll keep it tight if we can in terms of responses. But I know probably on the mind of nearly everyone on this call is recession. Is it hard? Is it soft? Is there no recession? Right? Like, what's going to happen on the recession front? But I think almost like back in the early days of COVID, like we didn't know if you actually contracted COVID. We didn't know what that meant. And I think investors don't necessarily know what a recession means to their portfolio. So Brad, any comments or thoughts on whatever type of recession it is, how does that translate to my portfolio?
Yeah, we've been writing on this through 2022. And one of the things we've been calling is kind of the recession red herring. This idea that if we were able to perfectly time a recession from an investment perspective, we're kind of focused on the wrong thing. Markets are related to economies, but they're more cousins than they are twins. And so they don't perfectly overlap. And so, will we see a recession? We're expecting this question. So frankly, we put together a slide on it. And just because I spent all the time putting together a slide, I'll show the slide. So will we go into a recession in 2023? Possible, probable. The National Bureau of Labor Statistics holds the keys on that. And of course, they'll tell us when we've been there after we're probably already out of it. But as we look at leading economic indicators, a common point of recession, showing 9 consecutive months of contraction, that tends to be kind of leading towards a recession. But again, let's remember what a recession is. A recession is not abnormal. In fact, recessions happen about every 6.5 years since 1950. Now, some recessions are the GFC, right, where it's Bear Stearns goes down, then Lehman goes down, then AIG, and should I take all my money out of my bank account, right? There's these existential systemic events. Some of them are just classical cyclically led recessions where we got a little over our skis. We spent too much and then you pull back and unemployment rises and then you move on, right? It doesn't become this massive thing. But again, let's make sure as investors, we focus on the right thing. So this graphic shows the difference between markets and economies. Now, the green line is industrial production. That's economic growth or contraction. And the blue line is markets rising or falling. This is the S&P 500. Now, as you can see, they're related, right? They're not independent of one another, but they're not twins. And so on average, markets tend to peak 7 months before economies peak. And they tend to bottom 3 months before markets bottom. So whether you're trying to time the recession, you're trying to time unemployment, there's a lot of things that you could try to look at. But if you wait for the all clear horn on recession, markets have probably already moved on. And so this gets back to the idea of the lack of precision and the power of preparation. Let's use kind of this context that we're closer to the end than we are to the beginning to prepare portfolios towards the up. And then, if a recession comes, right, we're not necessarily trying to time a recession. We're trying to build thoughtfully diversified portfolios that can weather a recession and then prepare for the upside. Because it's not a question of if markets will ever go up again. It's just the big question is when.
Thanks, Brad. And I'm going to actually try to combine a couple of questions here. There are conflicting metrics out there, right? So China's opening up, that's good, but central banks are tightening, that's bad. And you can just kind of go, savings are dwindling, but spending remains up. And there's a good question here to tie that in with what are the biggest risks to our viewpoints at this point in time, and how do you tackle that from an investor perspective?
Biggest risks, like if you say kind of where is our bet, if you will, one bet is that we're not entering 2023 into a recession like the GFC, right? That we have this big, long, deep, protracted, somewhat existential recession, and that earnings aren't going to fall 13%; they're going to fall 40% or 30%. So if we're talking about a recession, we believe we're talking about a small R, not a big R. There's no certainty in that, right? So if there's a risk, there's risk there. Runaway inflation, right? The inflation takes off from here as opposed to moderating. That leads the Fed towards a higher terminal rate. It means the Fed has to be far more hawkish for a longer period of time. That's a risk to this outlook. Again, looking at historical context, right? It's unlikely that the Fed will go from where they are today to 6, 7, 8, right? That would be highly unlikely. It's possible, just not probable. So those would be risks that would underlie kind of underlying assumptions to where we are today. We think those are fairly low probabilities.
And so that's great, Brad. And I think the answer is, as the answer often is, so what does an investor do? You build broad, thoughtfully diversified portfolios, which effectively is at the core of our entire investment approach. And, you alluded to this earlier, but what didn't work for 10 years of free money is likely what's going to work, and that are these broad thoughts. So whatever happens on those points, we believe the broad, thoughtfully diversified portfolios make sense. So combining a couple of other questions, the firm's view on kind of ties in on a go-forward basis on alternatives like PE and venture and real estate, and then why such a small allocation to tips?
Yeah. So alternatives, so let's take PE and call it hedge funds in two separate buckets. PE has had a great run over the last decade or more. Private markets are not immune to economic cycles or what's happening in the public markets. The public markets are just more reflective immediately of lower prices, whereas private markets don't have that issue on a day-to-day basis. So if we enter a recession, right, private markets could be just as affected as public markets. Now, the difference is you're investing over a period of time. If you buy a private equity fund today, they're going to be buying companies over the next 3 years, not just today. And then those investments are going to stay in that portfolio for 10 plus years, right? So you're mitigating some of that timing risk. So private markets, where it's applicable to a client, it makes sense from an illiquidity, a taxation, et cetera, to the plan, still can make play an important role in portfolios today. On the hedge fund side, interesting enough, this idea of persistent volatility, rising interest rates, fundamentals matter more, that actually is a good tailwind, what we think, for marketable alternatives, in which they can add more alpha, add more value. And then if we do have this more normalized volatility and higher inflation, having components in the portfolio that aren't beta one, meaning they just, markets are up, they're up, markets are down, they're down, right? They're a little bit more, they beat their own path. That's a benefit, and we think can continue to play an important role. They were a great diversifier in 2022. We have no reason to suspect that isn't the same, if not strengthening going forward.
Thanks, Brad. And anything in our closing minute that you'd like to underscore or add at this point?
It's a good question. I think one of the things I do want to note, right, as we think about our final theme on a bear market bottom, patience is something the world seems to be fairly short on. And I get that. I have 2 young boys, so I realize where patience is lacking. When we think about a bear market bottom in 2023, our notion there is in the calendar year of 2023, not today or tomorrow or in Q1. It might be today or tomorrow or Q1, but we don't know, right? So as we think about how 2023 progresses, I don't want to get caught if we have this conversation in 3 months and say, well, the markets they haven't perfectly bottomed yet. What we're looking for is adding, 2023 on whole is a better year to be actively investing than 2022. And so how do we prepare, build resiliency in portfolios? That's what we're doing today. So if I have one takeaway, I'd say have patience, right? Because volatility is likely to persist, but we do think now is a better time to enter than what we were looking at the end of 2022.
Awesome. Thank you, Brad. And so we'll wrap it there. We just want to, on behalf of all of our colleagues, thank everyone for attending today. We also want to encourage you to hit our website, the Insights section. A lot of what Brad is referencing today, we've got white papers and blog posts and podcasts and so on that really nicely parallel what Brad is mentioning. And then please feel free to reach out to any of your contacts at the firm if we can help or assist in any way, shape, or form. Very, very best wishes to all. We wish you a great 2023.